What if I told you that every single financial move you've made over the last 2 years to protect yourself was protecting you from the wrong threat? Not slightly off, not close but no cigar, completely wrong threat. And here's what makes that terrifying. The moves you made weren't stupid. They were textbook. They were exactly what every financial advisor, every YouTube channel, every podcast told you to do. Defensive stocks, cash reserves, some treasury exposure, maybe a little gold. Sound familiar? Here's the problem. Every single one of those moves was designed for a recession, a temporary dip, a cyclical contraction that eventually reverses. But what is actually coming at us, what is already arriving, is not a recession. It is a structural reset of the global financial system. And if you're holding a recession playbook right now, you are about to find out the hard way that those are two completely different games. Stay with me, because in the next 20 minutes, I'm going to show you 3 things. First, why the playbook most people are using is not just outdated, it's actively dangerous in this environment. Second, the exact mechanics of what's actually happening beneath the financial headlines that most analysts are still refusing to name clearly. And third, and this is the part that changes everything, a concrete framework for positioning yourself as an architect of the new system, not a casualty of it. Because at WealthForge, this is what we do. We don't follow the market. We design the moat. In a world of followers, we are the architects of our own freedom. Let's get into it. The illusion of traditional safety. I want to start with a story, and I want you to notice how it lands. The smartest money managers on Wall Street are holding mortgage-backed securities rated AAA, the gold standard, the textbook definition of safe, AAA. These are serious people running serious funds with serious risk management teams. 18 months later, those AAA assets vaporized, not because the managers were stupid, not because they made reckless bets, because the framework for what safe meant was broken. That is exactly where we are today, except the broken framework is not a credit rating. It is the entire concept of what defensive investing means in 2025 and 2026. Right now, millions of people are doing what they've been told is smart. Blue-chip dividend stocks, utility companies, consumer staples, maybe a sleeve of bonds, 6 months of cash sitting in a high-yield account earning 4 and 5%, and they feel secure. Here is what they are missing. Cash earning 4.5% in a world where your real purchasing power is declining at 7 to 9% annually when you actually account for housing costs, food, energy, services, is not a defensive position. That is a slow bleed with a comforting number on the screen. You're watching your balance stay flat while the actual value of what that number can buy shrinks every month. And defensive stocks? Let's talk about that trap. Utilities, consumer staples, healthcare, these sectors hold up during cyclical recessions because demand is inelastic. People still need electricity, groceries, medicine, regardless of economic conditions. The logic is sound. But only if the financial system itself remains structurally intact. What happens to a utility company when energy policy is rewritten by geopolitical trade blocs? What happens to a consumer staple brand when supply chains restructure around regional alliances rather than global efficiency? What happens to healthcare access when new digital scoring systems determine who qualifies for what tier of service? I'll tell you what happens. The defensive thesis breaks, not gradually, suddenly. Here is the most dangerous idea in finance right now, and I want you to hear this clearly. The belief that a temporary market dip and a permanent structural realignment are the same category of problem, just different in scale, is going to be the most expensive misunderstanding of this decade. They are not the same. A recession is cyclical. It contracts, it hurts. Central banks cut rates, liquidity floods back in, and 18 to 36 months later, you're recovering. That is the pattern. That is what your diversified portfolio was built to weather.
A structural reset is categorical. The rules of the game change. The institutions that backstop your assets transform or weaken. The currency your wealth is measured in shifts in fundamental value. And the playbook that worked in the old game doesn't just become ineffective, it gives you a false sense of protection while the floor is being replaced beneath you. Now, I know what some of you are thinking. Dr. Ben, this sounds alarmist, and I get that, I do. But stay with me, because the second part of this conversation, the mechanics of what's actually happening beneath the financial headlines that most analysts are still refusing to name clearly, is the way this goes from abstract concern to something you can act on immediately. And that part starts right now. The mechanics of the Great Reset. Let me give you the clearest picture I can give of what's happening beneath every financial headline you're reading. Since 2020, the global economy has been undergoing a transformation that economists are calling the shift from a debt-fueled consumption economy to a resource-constrained production economy. Let me translate that. For 40 years, the engine of global economic growth has been debt, consumer debt, corporate debt, sovereign debt. The game was simple. Borrow cheaply, spend aggressively, generate economic activity, collect fees and taxes on that activity, and keep the debt rolling forward. Growth was manufactured. Prosperity was borrowed against the future. That model had a lifespan, and we are living through its end. The resource-constrained production economy looks fundamentally different. In this model, what you actually have, real, tangible, productive assets, determines your economic position, not what you can borrow, not what your paper portfolio says you're worth, what you can produce, extract, generate, or physically control. This is why the world's sovereign funds are buying farmland. This is why China spent the last decade acquiring mineral rights across 3 continents. This is why energy independence has become a geopolitical obsession that transcends any single administration or election cycle. They are not hedging a recession. They are repositioning for the new model. Now, on top of this macro shift, we have 2 forces that are about to fundamentally change what it actually means to own an asset. And when I share these, I need you to hold your immediate reaction, because your first instinct might be to dismiss this as speculative, but the data is already there. The pilots are already running. Force 1. Central bank digital currencies. By 2027, we will have multiple major economies either piloting or fully deploying CBDCs. And I want to be very precise about something most people miss completely. A CBDC is not just a digital version of cash. A CBDC is a programmable currency, which means the issuing authority has the technical capability to define conditions for how, when, and on what your money can be spent. Expiration windows, spending category restrictions, geographic limits. I am not claiming that will happen tomorrow. I am saying that owning a currency that can, by design, be controlled at the transactional level is a qualitatively different form of ownership than anything any of us grew up with. And that difference has profound implications for where you hold your liquid wealth. Force 2. ESG-driven financial access scoring. This is the one that almost nobody in the personal finance space is connecting yet, and they should be urgently. We are watching the emergence of scoring systems that go beyond traditional credit, systems that factor in your energy consumption footprint, your investment profile, your geographic mobility, and, in some pilot frameworks, your digital behavioral data to determine your level of financial access. This is not a future scenario. Pilot programs exist right now. The direction of travel is clear. What this means for your portfolio is this: access to the financial system itself could become a conditional variable, one that depends on factors entirely outside your fiscal behavior. The prudent saver who checks every conventional box could find themselves facing access restrictions based on criteria that didn't exist 5 years ago. Let that land for a second. And then there's the restructuring of global trade architecture. For 30 years, globalization ran on one simple logic: produce where it's cheapest, sell where it's richest, and connect everything through dollar-denominated financial rails. That model is fragmenting fast. What's replacing it are what analysts are beginning to call regional trust blocks. Geopolitical and economic alliances that trade preferentially within their network, settle transactions in their own currencies or digital instruments, and build supply chains optimized for resilience rather than cost efficiency. This is not a recession phenomenon. Recessions don't restructure the global reserve currency system. Recessions don't redraw the map of who trades with whom and in what currency. This is something categorically different. And right now, I want to connect that directly to you, because I know some of you are thinking, this is happening at a macro scale. What does this actually mean for my money, my savings, my family? Let me show you exactly what it means. And this is where the real vulnerability in most people's current positioning lives. Why recession-proofing fails today. I want you to picture someone you know, someone careful, responsible. Maybe it's even you. They've diversified. They've got a mix of stocks and bonds. They've got a real estate investment, maybe some international exposure. They've listened to smart advisors. They've done the work. And they are completely exposed to what's coming. Not because they were reckless, because the framework they used was designed for a world that is actively being dismantled. Here's the issue with diversification across paper assets, stocks, bonds, ETFs, REITs, in a structural reset scenario. Diversification protects you beautifully against volatility within a stable system. But when the system itself is under structural stress, diversification becomes correlation. We saw this in 2008. Supposedly uncorrelated assets collapsed together because they all shared one hidden dependency, the functioning of the interbank credit market. Pull that single thread and the entire tapestry came apart simultaneously. The new hidden dependency, the one your advisor is almost certainly not discussing with you, is counterparty integrity. Every paper asset you hold exists because of a chain of institutional promises. Your stock exists because a brokerage holds it in custody. That brokerage depends on a clearing system. That clearing system depends on the stability of the sovereign debt of the nation whose currency settles the trade. In a normal cyclical downturn, counterparty failure is a tail risk, unlikely, extreme, not worth building your whole strategy around. And your advisor is right, in a recession. But in a structural reset, counterparty integrity is precisely what comes under systemic pressure. Institutions that have been operating on the assumption of perpetual dollar dominance, of globalized settlement infrastructure, of stable sovereign credit ratings across major Western economies, those assumptions are being stress-tested in real time, right now, as we record this. And then there's the liquidity trap. This one is subtle, so stay with me. Liquidity is your greatest friend in a cyclical downturn. The market drops, your cash is ready, you buy discounted quality assets, and you ride the recovery. That strategy has worked beautifully for 60 years. But in a reset scenario, staying liquid in a fiat currency that is losing its structural backing is not a defensive posture, it is exposure. The rules of this financial game are being rewritten mid-game, and if you're holding chips from the old casino while they're building the new one around you, the value of those chips is not guaranteed to transfer. So what do you do? Because I am not here to leave you with a problem and no architecture. That is not WealthForge. That is not what we do. What we do is build, and the building starts right now. Building a reset-proof foundation. The framework I want to introduce you to is what I call agile sovereignty. Agile sovereignty is the practice of structuring your assets, your skills, and your physical positioning so that your financial well-being does not depend on the continued stability of any single institution, any single currency, or any single jurisdiction. 3 pillars. Let's build. Pillar 1. Decentralized assets and hard commodities outside the legacy finance system. The goal here is not to abandon modern finance or retreat from the economy. The goal is to hold a meaningful allocation in assets that exist outside the institutional promise chain, underpinning the legacy financial infrastructure. Physical gold and silver, not ETFs, not paper gold certificates, but allocated physical metal held in your name, have been stores of value through the collapse of every paper currency system in recorded history, not because of tradition, because because they exist independently of any institution's promise. Energy assets, direct ownership positions in producing properties, royalty interests in resource extraction, agricultural land represent another category in a resource-constrained production economy. Ownership of things that produce real physical value becomes the new benchmark of wealth. Select hard asset digital currencies with genuine proof-of-work infrastructure, not speculative tokens, not yield-chasing instruments, represent a third category for those who understand them. The key question is, does this asset require real-world energy expenditure to create, or is it purely conjured from financial engineering? The principle is simple. Own things that would still hold value if 3 major banks failed next Tuesday. Pillar 2, proof of work skills and local utility. This one sounds the least like traditional financial advice, and it might be the most important thing I say in this entire conversation. In a structural reset, the most economically resilient people are not necessarily those with the most sophisticated paper portfolios. They are the people who produce something real,
who have skills and capabilities that generate genuine value regardless of what the market is doing, regardless of what the dollar is worth, regardless of what the institutional credit system looks like in 3 years. Technical skills in high-demand fields, energy systems, food production infrastructure, water management, advanced manufacturing, cybersecurity. A local business that solves a persistent community problem. A professional credential that makes you indispensable in the emerging model rather than the declining one. The question I want you to sit with tonight is this. If the financial system restructured significantly over the next 3 years, if your current income stream was disrupted by forces outside your control, what is your proof of work? What can you actually produce independently of the institutional infrastructure? This is not a pessimistic question. It is the most empowering question you can ask, because the answer is entirely within your control to build, starting this week. Pillar 3, geographic and jurisdictional flexibility. The ultra-wealthy have always understood this pillar. The middle class has dismissed it as out of reach. That gap is closing faster than most people realize. In a world of regional trust blocks and programmable financial access, the jurisdiction where you hold assets, earn income, and maintain legal residency can be as strategically important as the assets themselves. This does not mean abandoning your home country. It means understanding that second residency programs, properly structured offshore asset positions, and international banking relationships are not instruments for hiding wealth. They are legal, established frameworks designed to ensure that your financial access is not held hostage by a single jurisdiction's regulatory decisions. Several countries in Southeast Asia, the Caribbean, Eastern Europe, and parts of Latin America currently offer residency or citizenship programs that provide genuine jurisdictional optionality at price points that have become accessible to a growing segment of high earners and self-employed professionals. The question is not whether you'll want this optionality eventually. The question is whether you'll have built it before you need it. The roadmap. Next 3 years. Let me now give you a concrete timeline, because understanding what's coming is one thing. Knowing when and what to do at each stage is what separates positioning from panic. 2025 to 2026, the consolidation window. We are in this phase right now. The structural changes are visible to those who know where to look, but mainstream financial media is still largely interpreting events through a cyclical recession lens. Inflation is moderating, rate cuts are coming, the soft landing is holding. That framing is not entirely wrong. It is profoundly incomplete. During this window, the single highest leverage action you can take is auditing your current portfolio for single system dependency. Go through every asset you hold and ask honestly, does this asset only hold value if the existing dollar-denominated, institutionally managed financial infrastructure remains fully intact? Be honest, most paper assets will answer yes.
That is not a reason to panic. It is data. Use it. This is also your window to acquire foundational hard assets at pre-crisis prices. Once these transitions become obvious to the mainstream, once trade block realignments are front-page news, you will not be acquiring at the prices available today. 2026 to 2027, the transition pressure phase. This is when we expect the first significant systemic friction points to become undeniable to the general public. CBDC rollouts in major economies, continued fragmentation of dollar-based global trade settlement, potential sovereign credit stress events in overextended Western economies, regulatory tightening around capital mobility in specific jurisdictions. During this phase, those who position during the consolidation window will have options. Those who are reacting will be chasing. And the difference between having options and being forced to react in a structural transition, that difference is measured in years of financial progress, not months. 2027 and beyond, the architecture phase. By this point, the new financial architecture will be visible enough that the majority of people will finally understand what was actually happening beneath the surface over the previous 3 years. New reserve arrangements, new trade settlement systems, new frameworks for asset ownership and financial access. At that moment, the question will not be whether you understand what happened. Everyone will. The question will be whether you are standing inside the new architecture as someone who built within it or outside it, looking in, trying to figure out how to rebuild from where the last system left you. This is the critical fork in the road. Survivor of the reset or architect operating in the new system. That choice is being made right now in the decisions you take this week, this month, over the next 12 to 18 months. I want to finish with something concrete because I know it's easy to sit with the scale of everything we've covered today and feel the weight of it rather than the opportunity in it. And I need you to land in the opportunity, not the weight. So here are 4 things this week, not next month. First, do the single system dependency audit on your current portfolio. Write down every asset. Ask the question. Be honest. You need to know your real exposure before you can design anything better. Second, define your target allocation to outside the system hard assets. Most sophisticated allocators working in this space today are recommending somewhere between 15 and 30% of investable wealth. You don't have to get there overnight, but you need a number and you need to start moving toward it with intention. Third, have the jurisdictional conversation with yourself. Research 1-second residency program that fits your life situation and financial profile. You don't need to apply this week. You need to understand the landscape before you're in a position where you need it and are making decisions under pressure. And fourth, and this is the one most people skip, identify one proof of work skill you can build or deepen over the next 12 months, something that generates real economic value independent of institutional conditions. Invest real time there. This is not optional if you are serious about agile sovereignty. And above all, make the mental shift. Stop thinking of yourself as someone trying to protect what you have from an incoming storm. Start thinking of yourself as an architect, someone designing a structure built specifically for the world that is arriving. That is the entire difference. At WealthForge, that is the work we're doing together, not as a community of people following the market and hoping for the best, as architects, people who design their financial future with intention, with clarity, and with the courage to move before the window closes. We don't follow the market. We design the moat. In a world of followers, we are the architects of our own freedom.
If this conversation shifted something for you, if you're seeing the landscape differently right now than you were 20 minutes ago, subscribe and share this with one person who needs to hear it. Not because it helps our numbers, because the people in your life deserve to have this conversation while they still have time to act on it. I'll see you in the next one.